Hi, I'm Patu from freefincal, and let's do two things in today's video. Let's have a look at how active equity mutual funds or actively managed equity mutual funds have performed against representative category indices. That's the report published in today's post. You can see the link in the description box. This is based on the freefincal equity mutual fund screener. The link for that is also in the description box. Once we look at that, we will head over to the question and answers session for this week, where I'll be taking questions that viewers have asked. So here you can read the description here, but I'll not get into too much of this. I'll just show you the main result. So for each of these categories shown, there are 7 categories: large cap, multi cap, ELSs, etc., etc. And there's a representative category benchmark that I've used in the screener. And if you look at the large cap category, there are 29 actively managed large cap funds, excluding about 19 Nifty Sensex and Nifty Next 50 index funds. There are 29 actively managed large cap funds as of today. Now, given those 29 funds, over every possible 5-year period between April 2006 to May 2019, if we compute every possible 5-year periods, we ask, out of those every possible 5-year periods, how many funds have outperformed the Nifty 100 total returns index at least 70% of those durations? How many of them have outperformed Nifty 100 total returns index at least 70% of the every possible 5-year periods between April 2006 to May 2019? That's what the screen will do. And the total returns index means that the dividends will be treated as reinvested, and there are only 17 out of those 29 funds which have outperformed. The next bit is what is shocking. So for a given 5-year window, if I look at the monthly returns in that 5-year window and find out how did the fund perform for those months when the index gave a negative return, and I calculate what is known as the downside capture, this will tell you how much of the index losses has the mutual fund captured. So if the downside capture is 80%, that means the fund has only captured 80% of the index losses. So less than 100 is good. And we ask, out of every possible 5-year period between those 2 years I just mentioned, how many times has the downside capture been less than 100? And is it 70% of the total available durations? So when we ask that, then that 17 falls down to 8. An actively managed fund is supposed to lower risk, and only 8 funds are managed. That's probably the most pathetic statistic of this whole post. If you look at the multi-cap funds, there are 42 funds, but if you ask how many of them have outperformed at least 70% of the available 5-year periods, only 15. Only 15. That's atrocious. And look at the indexes: Nifty Large Mid Cap 250. So this is 50% of Nifty 100 plus 50% of Nifty Mid Cap 150. There was talk about Motilal Oswal bringing an index for this and so on, but that's not going to happen. Nobody in the right mind will bring it, otherwise their own funds will suffer. That's not going to happen. But look at that. And if you notice, from 15 I go to the downside protection filter I just applied, there's not much change. And again you see here 9 to 8, but in ELSs out of 31 only 9 qualify. But then from that 9 there's not much change, and so on. You can read off the rest by pausing the video, or you can see the full data in the screen. So there are 2 main takeaways here. More than 50% or more than 50% of the funds in a category have not been able to beat the index consistently. And we are looking at data from April 2006 onwards to 2019. This is not some recent trend I'm talking about. Please have that clear in your mind. And it's not just large cap funds, this is all the funds. Whether it is ELSs, whether it is large and mid cap, whether it is value oriented, mid cap and small cap have performed a little better. The main reason small caps have performed a little better is because many of them invest significantly in mid caps. So when the small cap index falls, the losses are protected well. That is the reason why small caps have done well. Well, that's the irony of actively managed investing. You have to deviate from the index to beat it. So, well, you can't. So that's the status of actively managed equity funds as on May 2019. We do not know which of these funds are going to beat the index in future. So you will have to actively manage your actively managed mutual funds if you want to beat the index. And second, notice that almost all the funds which have bet the index, that is the middle number here, also have managed to have good downside protection. That is, they fall less than the index when the index falls, except for the large cap category. So search for funds with good downside protection, then you will more often than not end up with beating the index over the long term. This is the fundamental principle of my portfolio construction. I have been advocating aggressive hybrid funds or multi-asset funds or balanced advantage funds as a sure shot way of getting lower risk from with respect to the index. So you're able to justify the extra price that you pay to the fund manager. So those are the categories. I just talked about best category for retail investors. You can see that video. This is the reason why I keep saying you're guaranteed of that downside protection. You're guaranteed of lower risk when you buy hybrid funds. So that is that. If you have any questions on this, please comment below. Do click on the report and have a full look at it. You can get the mutual fund screener as well. Now let's head over to the Q&A. So this is my comment feed in the channel, and a couple of days ago I had talked about maybe a week or so about mutual fund portfolio overlap tool. I am getting a runtime error type mismatch. You can't just say that. You will have to talk about, you will have to say, I am running your tool on a Mac or a Windows. I am using Excel this version, and when I click that button, I am getting this error. Of course, for the portfolio overlap tool, I know which button. There's only one button, but you will have to give those details. And if you are running on a Mac, it will not work. So I can't just you can't just say it's not working. Why do you want the, so yesterday I talked about the India VIX, the volatility index, and somebody says, why do you want the India VIX to crash? It just means temporary loss of volatility. It's not an indicator of price trend. I'm not interested in price trend. I'm not interested in buying stocks based on whether the price is low, high, or whatever. And I'm just a poor poor mutual fund investor, and that too retail, or maybe not retail, I don't know. So I just want the volatility to temporarily decrease. That's why I want the VIX to crash. I'm not a high level index investor like you are. You can expand the comment and read below. This is a post on Mirai Asset Focused Fund. Can I invest in this Mirai Asset Focused Fund? It is the new fund. Suggest anybody. I had mentioned clearly there's nothing special in this fund. So those of you who are interested in helping him out, please go to that video and suggest to him whatever you like. And this is a video on how to book profits from small cap funds. By the way, you can actually search for my channel. Let me just quickly go over, and maybe I can show you. Let me just show you. Just click on this very quickly. So if you just type on freefincal, that will tell you the videos. Go to that, and if you go to the main channel, there's this button here. Use this search option to search for videos, and you will be able to. So first search there, then you can ask me make this video, that video. I'll be able to do it. So you can search for these videos there. So I talked about booking periodic profit from small cap, looking at moving averages or market valuations. This is not this is practically difficult. Can you please share any other methods for small cap fund? No, I do not know any other method. This comment is not based on this video, but just thought to post it so okay, it doesn't get missed. I am predominantly an index investor, and after being an active investor, active reader of freefincal, today I came across a 7-minute video on index investing from Dhirendra Kumar of Value Research. I'm sharing the link and request you to throw some light in the future video on the flaws of index investing mentioned in the article. First of all, I am a believer in data. When I see data, I make my I create my opinions based on data. I have just showed you data of the performance of actively managed equity funds. You can look at the data and decide for yourself. I have no interest in viewing that video. It's a waste of my time. I have no interest in finding out what Dhirendra Kumar or Value Research or anybody has to say about index investing. If I want to know about index investing, I'll take the NAV and do the calculation myself. It's up to you whether you take my calculation seriously or not. Please don't ask me to read this or that. I will not do it. It's a waste of my time. I don't even read my own articles, which is why they are full of typos. I just don't have my time is precious. I cannot waste the time for such things. Sorry about that. Santosh Kumar keeps saying useful info. Thank you for every one of my video. Thank you. That's an interesting question. What is a sideways market? How to identify a sideways market? Can you share which periods were sideways markets in the past 5 to 10 years? Yeah, that's quite easy to do. Let's do it. Let's go here. Type Sensex. Go to the max. I hope this works. Yeah. So I'll show you the sideways market here. You can see, well, how do you define a sideways? The biggest sideways market in the history of the Indian stock market was after the Harshad Mehta scam broke, and there was a 10-year, that's the sideways market right there. That's a 10-year period in which the index did not move anywhere until 2002, 2003 or so on. That's the 1990s was a very difficult period for the Indian government and the Indian economy, because the Indian government was on the verge of bankruptcy. ETF rates was 12%. We were forced to liberalize the the economy and so on. That was a very bad period. So how do you define a sideways market? There are many ways to do it. For example, you see this crash here. That's the 2008 crash. You can say this is a crash and recovery, but another way to say it, that this market was not moving upwards during this period. So any period in time where the market never moved up is a sideways market. So from this peak here, the market did not move up for that much time. That's another sideways market. That's another sideways market. There's another small sideways market. So you can see, for example, you can define a sideways market by, you can say that's a sideways market for the last 1 year. So it's any time. So when the index is moving up, you call that a bull run. People call a bull run today, even if it moves up by 0.1%. So it moves up, then it starts falling down, and then it can crash and then recover gradually or over a period of time, or it can just do nothing. And that's a sideways market. See, please recognize a crash, sideways market, bull market, bear market, all these things can only be known in hindsight and when enough time has lapsed after a certain event has passed. So you cannot say that in real time. See, for example, if you look at the last 1 month, is that a sideways market? I don't know. Last 1 year, it started here and it has only gone up there. But if I look from here to there, maybe that's a sideways market. But again, I'm looking at it in terms of I'm looking at it in hindsight. So that's the sideways market. Whatever it is, the main point is that when the index is not moving anywhere, that's the wonderful time for you to invest, dump your money into equity. Of course, as long as the money is needed for very long-term goals. Okay, so that is that. I have 9 funds in my portfolio. I've now decided down to 5 max, and out of 5 funds, there are 2 new funds and currently old funds in between, 2.5 lakhs each in old, returns in negative. What is the way forward in switching? Look at first of all, identify the funds you want to retain, and you must justify it to yourself quantitatively why you want to retain them. It's okay for a fund to have a negative return for the last 1.5 year, 1 year. That's okay, but that is not the reason why you should reject it. But you should first build a portfolio. Ask yourself, what is my portfolio constitution going to be? I'm assuming these are equity funds. So in my equity funds, how much is going to be large cap, how much is going to be mid cap, how much is going to be small cap, or I'm going to have a score as my aggressive hybrid fund or a multi-asset fund. Then I'm going to have a little bit of mid cap and a small cap. First, have a design in your mind. Don't worry about these funds. According to that design, you change your portfolio gradually. Have a plan. I can't say that trim this. I can't do that. You must have a plan and work on that. I've been wondering about this after I saw your yesterday's video. Is it possible to let us know how to do this? What is it okay to have the same fund for all goals? There are around 4 to 5 aggressive funds available. I have 2 portfolios, retirement plus money for startup plus 1 portfolio. My wife has her own portfolio. Should we use the same fund or should we use different funds? It is up to you. The point is that I cannot give you an answer of which is better for every possible question in portfolio management. Many things in portfolio management are really up to the individual. If you are comfortable, many people will say, I will have only 2 funds or 3 funds for all my goals. Fine, go ahead. I have different funds for each of my son's education goal is different. It has got 3 funds. My retirement goal is different. That's got 3 other funds. That's what I am comfortable with. If you can justify this plan to yourself and you are comfortable, and if you think you can manage this quite comfortably without losing your time or your head, then go ahead and do it. Just don't worry about it. Right? See, please recognize at the end of the day, returns don't matter. We just need money. That's all. Don't worry about it. Selva says, summer work, thank you. Sir, in terms of risk, how does gold fare with multi-cap? Oh yes, I have done a video on this. Investing in gold is more riskier, more volatile than equity in terms of the risk ladder. If this is diversified equity and that is sectoral funds will have higher risk. Gold will be somewhere in between. I have a post on this, you can have a look at it. Let's talk about Nifty Blend, which is a combination of index funds, Nifty 50 and Nifty Next 50. For whom does, any new investors who don't have, who believe in index investing, who have got small portfolio sizes can use Nifty Blend. There's no problem at all. Who understand what they are doing. Brilliant video, good question about which is the best category for retail investor. Fetched a good answer. Thank you. Yes, good questions make all the difference. What does this love symbol mean? It means I like your comment and I have acknowledged your contribution to the channel. So this is a question. See, let's make this the last. Otherwise, it will be a long video. There's a common problem in the advisory community where they say if you have a 2-year goal, you should buy a debt mutual fund which has got an average portfolio duration of 2 years. That is complete nonsense. It's bullshit. I have a article on this. If you are more interested, if anybody is interested, I can create a video on this and why this is wrong. So that's about it. If you have any more questions, keep commenting and I will take them up in future videos. Thank you as always for watching. Bye bye.